Hello everyone, I am JC and welcome to the channel. In today's video, we are going to talk about ACE Energy or Acen's fundamental analysis. So without further ado, let's start now. This presentation is about ACE Energy Philippines or Acen. But before we proceed with the fundamental analysis proper, let us first have a short background of the company. So ACE Energy or Acen is the energy platform of Ayala, which is one of the largest business groups here in the Philippines. And ACE Energy is one of the fastest growing energy companies with over $2 billion of invested and committed equity in the renewable and thermal energy here in the Philippines and around the region. So later, I'll show you what regions are they planning to operate. And let's move on to the ownership. So as we can see here, the first one is the PCD Nominee Corporation, but this is comprised of the traders and retailers account, which aggregated 52.40% or 7 billion shares. And the second one is Ace Energy Inc. with 45.17% ownership. If you do not know Ace Energy Inc., it is one of the subsidiaries of Ayala Corporation, which is here Ace Energy Inc. or ACEI, which is in the power sector, which is 100% owned by Ayala Corporation. So what does this mean? So whatever Acen derives from its operations goes to Ace Energy and then subsequently goes to Ayala Corporation. And now let's proceed with the board of directors. And as we can see here, it is headed by the Ayalas. And if you do not know Ayalas, they are one of the best leaders here in the Philippines. And here we have here the geographical locations of the plants of Acen. As we can see here, majority of their plants are in the Philippines with some in India, Vietnam, Indonesia, and some of it are still under construction as of July 2020. So we have here 1, 2, 3, 4, 5, 6, 7 plants under construction. So this does not yet contribute to the revenue of the company right now. But in the future, they will contribute to the company's revenue and increasing its profit. Now, let's have a short industry overview. I have attached here an article from Inquirer.net as of September 21, 2020. It says here that the future energy is headed in the direction of a cleaner and more efficient sustainable resources, just like what Acen is. And the world's largest economies, led by the German, Japan, and UK, are rolling out plans to transition from coal to more sustainable energy sources such as solar, hydro, geothermal, and wind energy. So this is basically what Acen is targeting right now. So there's another one here stating that coal has no future. Why is that so? Because when burned for energy, coal emits massive amounts of greenhouse gases, which contributes to climate change. Right now, we are experiencing tremendous effect of climate change, including flood from the previous typhoon. So basically, we need a more sustainable and cleaner sources of energy and other resources. So we need to save our environment. And now, let's proceed with the financial analysis. So we have here the cash flow analysis comprised of those coming from operating, investing, financing activities, and minimal foreign exchange. So we can see here that the cash flows of the companies from operating activities increased from 845 million to 2 billion. So why is that? So because of the increase in the income of the company. And then the next one here, the biggest one, is the net cash used in investing activities amounting to 11 billion. Why is this big? It is because of the acquisitions of the company of various businesses, including Giga Ace, Sakasol, and Islasol, which run solar farms. So basically, it's invested into companies and into assets, including solar plant assets, diesel-fired power facility, among others. So this investment will benefit the company in the future by converting these invested assets into revenue. Later, I'll show you how does the company convert its assets into revenues. The third one here is the increase in financing activities. So we have here 6 billion of increase in cash due to the financing activities coming from the availment of loans, mostly to purchase the above investments. So it is used to purchase these businesses and these assets. And what can we conclude from here? The company is currently acquiring more assets for the expansion of its operations in the renewable energy platform. This may result to the increase in the company's revenue in the future. So right now, we will not experience yet the effect of these investments. But in the future, we'll see how much these investments contributes to the company's revenue. Now, let's proceed with the ratio analysis. The first one here are the liquidity ratios. For those of you who do not know what a liquidity ratio is, it measures how a company will be able to meet its obligations in the next 12 months. And it may also be used to assess if a company will be able to pay out dividends. So a higher current ratio means that the company will be able to pay its obligations in the next 12 months. And as we can see here, there's a drop in the current ratio and asset test ratio. So why is that so? These are mainly due to the acquisitions of businesses and assets of the company, which is good in the longer term. Now let's proceed with the solvency ratios. So we have here the asset to equity ratio, interest coverage ratio, and net bank debt to equity ratio. So what does this ratio mean? So a high equity ratio and net bank debt to equity ratio means that the assets of the company are mostly financed by debt. Actually, there is no ideal asset to equity ratio because most of the times it is cheaper just to avail loans rather than to issue shares to the public in order to get funds. Because when you issue shares, you dilute the shares of the existing shareholders, which the shareholders do not want. And there's also there's also less requirement when you avail of loans rather than processing a follow-on offering because you need to apply in SEC. But when availing loans, you just need to submit your financials in the bank and have it approved like that. And the next one here is the interest coverage ratio. We can see here that there's an increase in the interest coverage ratio because of the increase in the net income of the company. So a high interest coverage ratio means that the company can afford more loans to finance its operations. We can connect this high interest coverage ratio with the high asset to equity ratio because if the earnings of the company can shoulder its loans, then it's basically going to avail of loans rather than issuing new equity into the public. And then here we have here the profitability ratios. And we have here the return on equity, return on assets, and asset turnover. So a high return on equity and assets depict how well a company generates profits out of its invested equity and assets, respectively. We can see here a tremendous increase on return on equity and return on assets. We have here from 2.51% negative to 22.09% and negative 0.92% to 7.24%. So what does this mean? So a peso invested in equity will generate 22% of returns, while a peso invested on assets will generate 7.24%. For example, you invested 100 million equity on this company and it will be able to get 22.09% out of that investment. So basically, you will get your investment back in just 5 years because 22.09% times 5 years is more than 100% and you will be able to obtain your equity in that time frame. For the asset turnover ratio, the only difference with return on asset is the numerator, which is revenue. So it measures how much an invested asset generate revenue. So in our previous examples, we have seen that the company invested so much in its assets and businesses. So the good thing is that they are able to convert the asset invested into revenue. So that's basically 27.4% of revenue for each peso invested asset. As you can also notice here, there's a drop in the asset turnover ratio. Why is that so? Because of the newly invested assets during the year, which does not yet earn revenue during the year. But in the future years, we'll able to see how much these assets generate revenue for the company. The next one, we have here the book value per share. You can see here that the total equity of the company is 20.42 billion as of the third quarter, and the total shares issued is 13.70 billion. So the book value per share is 1.49 pesos only. And what's the downside of using this book value in measuring the value of a company? The book value is basically the historical value of a share without considering the future growth of the company. So for example, you purchased a land 10 years ago worth 1 million. For example, a company purchased a land 10 years ago worth 1 million. What's the value in the financial statements? Assuming the company used the cost method. So the value of that land will still be 1 million. So it did not consider the future growth of that land. So that's the downside of using the book value. And the next one, we have here the earnings per share. We have here the unweighted EPS and then the weighted EPS. Why did I separate these two? Because during the year, there's new issuance of shares. And we know that these new shares did not participate for the whole income for the year, only a portion of those months. So we have here the 6 billion total issued new shares, while its weighted amount is only 2 billion. That means that this 6 billion is not participating for the whole year. But during the subsequent years, in 2021, this 6 billion will now be 6 billion in this calculation. So we have here the diluted EPS of 0.29 to be conservative as compared to the weighted EPS of 0.41 for the year. By the way, this is annualized, so I have calculated the net income of the 9 months and then multiplied it by 12. So we have arrived at 0.29 and 0.41 respectively. How about the price earnings ratio of Acen? In the previous slide, we have seen that the earnings per share of the company, assuming that all shares participate for the whole year, is 0.29, while its current price as of November 16, 2020 is 4.29. And its price earnings ratio basically derived from dividing the current price over the EPS is 14.8. Let us compare it with other company in the same industry. We have here First Generation Corporation with 8.1 price earnings ratio. Basically, the price earnings ratio of Acen is higher than First Generation Corporation. This means that the investors are expecting a higher earnings of the company in the future. For the renewable industry average, it is 8.9 because it's mostly comprised of First Generation Corporation because there are not lots of renewable energy companies here in the Philippines. How about the overall Philippine market? We can see here that the overall Philippine market is 14.1 PE ratio as compared to the 14.8 of Acen, which is quite close. And let's have an example of other companies in different industry. For example, SM, which is one of the best companies here in the Philippines, which has 45.8 price earnings ratio as compared to Acen of 14.8. And how about Merrimark Consumer? This is so high, so 388.6 because the investors are expecting higher revenues in the future of Merrimark. So a high PE ratio does not always mean that the stock is overvalued because investors are thinking of the future earnings of the company and not just the current earnings of the company. And now let's proceed with the stock right offering. Let us have a detailed explanation on this. So based on their disclosure, Acen will issue 2 billion shares at 2 pesos and 37 cents per share subject to the approval of SEC. And given the 2 billion outstanding shares held by minority investors, it gives them right to purchase 1 share for every 1.11 shares held by them. So let's have a further example here. For example, you have purchased 5,000 worth of shares of Acen at 4.29, which is the last price, and your amount of invested capital is 21,513, which is inclusive of tax. So what about your stock right? You have stock right to purchase additional 4,505 shares at the price of 2.37 per share. And your total additional capital to be invested is 10,708 inclusive of tax. So in total, you have 9,505 shares of Acen at a cost of 32,222, which reduced your average price to 3.39. And now let's differentiate the stock right offering versus the follow-on offering because there are lots of people getting confused by this. A stock right offering is an issuance of shares for existing shareholders. So if you have no share of the company, you cannot avail of the stock right. But this right is optional and not mandatory. You may opt not to purchase the additional shares of the company. while the follow-on offering is the issuance of the stock of shares following the IPOs. Basically, a company conducted an IPO and then they issue additional shares in the public subsequently. So this is given to the investing public regardless if they own shares of a company or not, but subject to allocation. And what will happen with the EPS after SRO? So we have here an illustration. Assuming the company's earning will remain the same, but it is less likely to be the same because we are expecting higher earnings of the company in the future because of its invested assets. And we have here, prior to SRO, we have 13 billion total shares with EPS of 0.29 and price earnings ratio of 14.79 and current price of 4.29. What about after the SRO? Assuming we have here same net income and the total shares issued will be from 13 billion to 15 billion, which is now 2 billion more than the previous one, we will have an EPS of 0.25. Assuming the PE ratio of the company will remain the same, the valuation of the company's share will be 3.70, while your average price after the SRO, assuming you purchased at 4.29 and avail of the SRO, will be 3.39 and you have possible upside of 7.65%. That's all for today, and I hope this presentation helped you if you are planning to make investing decision in Acen. So if you learned something, please click the like button and also consider subscribing. Thank you and see you on my next video.